Welcome back to Investing Talk Podcast. Today we are tackling, well, one of the most dramatically volatile and frankly complex stories in the microcap world right now, Brera Holdings. The core question we're really digging into is pretty simple on the surface. Is Barrera Holdings a good time to buy now? We're going to pull apart the historical financials, analyze this massive strategic pivot they've announced into digital assets, and look at the technical signals that have traders so focused. Before we jump in, just a quick reminder, if you want us to look into a specific company, please do leave a comment below. And as always, remember to subscribe, like, and comment. It really helps support this analysis.
Yeah, and this one's a particularly fascinating challenge, I think, because the company presents, it's a real study in contrasting narratives. Historically, what we had was a pretty traditional sort of struggling small-time sports company. Now suddenly they're attempting this huge, really speculative leap into the digital asset world. So for you, the listener, the immediate challenge is figuring out, are you buying a sort of shell company that's about to launch a massive new venture? Or is it just a sports club with some very big and maybe unfulfilled promises attached?
Right, and we really can't understand the, let's call it opportunity, without first understanding the crisis that kind of came before it. So let's start with that foundation. The Brera Holdings, everyone knew, up until pretty recently, their core identity was, well, rooted in the sports and entertainment industry. Primarily, they control the Italian football club US Juve Stabia. And it's worth noting they also recently sold off their volleyball division, UIBA.
Yeah, that's the background. But when we ground ourselves in the financial reality of that legacy business, the picture's pretty stark. If you look at the fiscal year that ended December 31st, 2024, the company was tiny. Revenue came in at only $2.1 million.
Wow, okay. That is extremely modest, especially
Yeah.
for a company that's publicly traded. And what about their operational efficiency? Were they making money?
No, that's where it gets really worrying. They reported a hefty net loss, $4.6 million for that same period. So the company was fundamentally unprofitable. It was operating with deeply negative operating margins, net margins. It basically indicates that their costs were just drastically exceeding any revenue they were bringing in.
And the cash position. I imagine that tells the story, too, probably one of struggling to keep the lights on. How tight were things before this massive pivot idea came along?
Extremely tight, yeah. At the end of 2024, their cash and cash equivalents, only $1.27 million. Meanwhile, total liabilities stood at $2.6 million. So they were operating with net current liabilities, which puts, tremendous pressure on the balance sheet.
Okay, and the critical thing here for any listener, especially someone learning, is the consequence of those numbers, right?
Absolutely. The key risk, and this was actually officially highlighted in their historical regulatory filings, was the inclusion of a going concern warning, which is, basically the auditor's way of saying there's substantial doubt about the company's ability to continue operating without sustained and, frankly, significant capital infusions. So this $300 million capital raise we're about to discuss, it wasn't just some strategic nice to have. It really looks like it was an absolute necessity to prevent, well, a potential collapse.
That context is so crucial because we stopped the clock right there before the big announcement. The answer to our question, is Brera buy, would be a pretty resounding no, wouldn't it?
The historical fundamentals just showed a small, unprofitable, cash-strapped company facing a real liquidity crisis. But as you said, this is where the plot takes a very dramatic turn. Indeed. Yeah, we're shifting completely from a narrative of, let's say, quiet financial struggle to one of massive, highly speculative potential. And it's all driven by this single announcement back in September 2025.
Okay, let's talk about that transformation. September comes, Barrera announces this immediate, huge shift into the digital world focused on blockchain. What was the headline news?
The headline was the announcement of a $300 million private placement. And critically, it was reported as oversubscribed. Now, just to put that $300 million in perspective, that single capital raise is nearly 150 times their entire annual revenue from the previous year.
Wow.
And oversubscribed means there was actually more demand from investors than the company was even looking to sell, which signals, incredibly strong market confidence or at least interest in this new, very speculative strategy.
And the purpose wasn't vague either. It was specific, right? Funding a Solana-based digital asset treasury. This isn't just like testing the waters. This is a radical redirection of the entire business.
Totally. And the reported backing kind of validates that pivot in the market size, at least for now. We saw reports mentioning institutional participation from pretty big names like ARK Invest and various UAE investors were mentioned too. That kind of injection of, let's call it blue chip institutional interest, even though the focus is speculative crypto, That's what's really driving the current valuation spike.
Okay, so why Solana specifically? If they're building this massive digital treasury, why pick that ecosystem? And what exactly is a digital asset treasury in this context?
Well, the strategic alignment there is quite interesting. Solana's known for its high transaction speeds and relatively low costs, which makes it theoretically ideal for managing a large, potentially actively traded treasury. The goal isn't just to, buy and hold Bitcoin. A digital asset treasury is usually meant to generate yield, so that could involve things like staking assets to help secure the network, or providing liquidity to decentralized finance protocols, maybe investing in the wider DApp decentralized application ecosystem on Solana. They're essentially trying to transform themselves into something like a crypto-focused hedge fund using Solana's plumbing, so to speak.
And this commitment is so deep, they're planning to change their whole identity.
Correct. Yeah, the plan includes a full rebranding. They intend to rename the company and shift their principal operations entirely over to blockchain technologies. The proposed new name, Soulmate, obviously signals that complete commitment to the Solana ecosystem.
Okay, this sounds incredibly ambitious, maybe even exciting for some. But the big question then becomes, what about the checks and balances? Isn't the single biggest risk here that the old sports management team,
Right.
the one that struggled to run a small football club profitably, is suddenly going to be running a highly complex $300 million digital asset hedge fund? I mean, what evidence do we have that they can actually execute this?
Right there.
Yep.
That is probably the single greatest structural risk for you, the listener, to really consider. The success of this whole pivot relies entirely on, let's be frank, unproven management executing a highly technical, heavily regulated, and extremely volatile financial strategy. But despite that massive execution risk, we have seen strong internal commitment, or at least consolidation. XX September Holding, which was already a major shareholder, increased its stake significantly through recent share issuance. They now control something like 41.7% of the company. So that massive consolidation shows, firm internal belief, or at least control over this new direction.
Okay, let's pivot ourselves now to the technicals, the trader's perspective.
Okay.
Which is obviously crucial when you're dealing with a stock driven almost purely by speculative momentum like this one. Brera is highly volatile, right? Typical microcap stuff, often seeing daily moves well over 10%.
Oh, absolutely. That volatility is driven by every single news headline, every rumor, every speculation cycle. If you just look at the recent action, say, over the past month, the stock's traded in a really wide range between $1.01 and $2.04.
So for short-term traders trying to navigate that, where are the critical support levels they're watching?
The really crucial support zone seems to be between $1 and $1.10. And that $1 mark is absolutely vital because, as you know, it's the minimum bid price required for continued listing on the Nasdaq.
Ah, right, the compliance threshold.
Exactly. The good news on that front is that they did regain compliance back in July 2025. So that removed the sort of immediate existential threat of a near-term delisting that was hanging over the stock earlier in the year. But they need to stay above that dollar. Resistance, based on the recent swings, looks pretty firm around the $2 to $2.10 level.
Okay. And if you are betting on the success of this Soulmate transformation, what are the next big things, the upcoming drivers or catalysts we need clarity on?
Well, the most immediate, absolutely critical short-term catalyst is the full transparent closing of that $300 million private placement. Until those funds are physically secured, accounted for, confirmed, it's still basically a promise, right? A promissory note.
Got it. Cash in the bank.
Exactly. Beyond that, the planned Soulmate brand launch and the actual public rollout of their digital asset strategy. That's scheduled for November 1st, 2025. That's the big marketing and operational inflection point the market is really waiting for.
And beyond the company's own milestones, there's also market chatter, right?
Yeah.
Speculation about external forces that could boost momentum.
Yeah, exactly. Given the very clear Solana focus, there are already rumors swirling about potential inclusion in, thematic blockchain ETFs. And furthermore, there seems to be growing expectation that some large hedge funds might have to disclose sizable stakes in their Q4 filings, assuming they bought in during the placement. Any of those kinds of external endorsements could dramatically amplify the buying pressure that's already there.
We've definitely covered the potential upside, which is, potentially huge if they pull this off. But this shift also introduces immense risks that we really have to stress. The company is essentially swapping one kind of risk financial struggle for a whole host of others, like operational and regulatory risk. What are the key downside factors?
I think the biggest immediate financial cost, certainly to existing holders who were in before this placement, is dilution. Massive dilution. That $300 million capital raise required issuing a huge number of new shares. So that means any future profits, even if the treasury is wildly successful, will be spread across a significantly larger share count, which severely limits the potential per-share returns for long-term holders who didn't or couldn't participate in that big raise.
Okay, dilution is a big one. And then there's just the operational reality of trying to juggle these two very different, very risky businesses.
Yeah, the execution risk just cannot be overstated. Setting up and managing a large-scale, high-yield crypto treasury, that's incredibly difficult. It involves complex regulatory hurdles, building operational infrastructure, things the current management team just has no documented track record of successfully handling. And now they're exposed to the high volatility of the crypto sector while still owning and operating in the inherently risky, capital-intensive sports sector with the football club. It's like a dual exposure to two pretty high-risk areas.
Okay, so let's try to synthesize all this for the listener. We have a company that was, frankly, desperate, found a massive lifeline through a hyper-speculative pivot.
Yeah, what's really fascinating here, I think, is that the entire investment thesis now rests solely on the successful completion and the successful execution of this digital asset strategy. That's it. If you connect this to the bigger picture, that historical business with its tiny revenue, and that going concern warning, it's now completely overshadowed by its extreme speculative momentum driven entirely by external capital and this one huge announcement.
Which leads us back to the overall investment rating from the sources we looked at. Despite the incredible potential upside for that $300 million coming in, the consensus view remains extremely cautious.
That's right. Our sources, collectively, give Barrera Holdings an overall rating of just 3 out of 10. And that low rating really reflects the current reality. The stock is suitable only for speculative short-term trading based purely on news catalysts and momentum. It is definitively not, at this point, a suitable long-term investment, not until there's transparent execution and, actual demonstrable success from this digital asset treasury. The risks from unproven management, the massive dilution, the regulatory unknowns, they're just too high for a fundamental case right now.
So what does all this mean for you, the listener? Well, the company needed a lifeline, and boy, did they find one. One that involves transforming from a struggling football club owner into a high-risk crypto asset manager. The provocative thought to leave you with is this. Given this incredibly rapid shift, how much value do those existing sports holdings like that Italian football club truly add anymore? Are they an asset or a liability to a new business focused primarily on a $300 million Solana digital asset treasury? Are you basically investing in a crypto treasury that's burdened by a football club, or a football club that happens to have a huge treasury attached? That's something to really mull over as you decide whether to jump into this speculation or wait and see if they can actually execute.